Hey, good morning, everyone. Marty Missouri here. It is Friday, the 20th of October, 2023. Just a little bit after the market open. This is your end of week market snapshot. I'll follow back hopefully later today. If not, it'll be over the weekend with, I think, an important economic update. So, true to recent form, I'm just going to offer up some commentary without messing too much with the charts for the first part of this morning's presentation. Then we'll get into the technicals in the second part. With regard to the latest action, you've noticed that the stock market has been struggling of late. Just a reminder, clients recall during our mid-year reviews, our July reviews, when the markets were up nicely, our core portfolio was up nicely, and I said, tongue in cheek, don't go spending it right here, because our view is that things are going to get worse, perhaps significantly worse, before they get better. Of course, as we have been for some time now, we're hedging the extreme swift downside move with S&P 500 put options, and we've got other kind of defensive positioning going on in our whole macro allocation in an effort to mitigate the lion's share of something notable to the downside while still being in a position to make some money if, like so many, think that the market is going to continue ultimately to melt higher without anything too severe to the downside. We don't know what the future holds with regard to that, but we do know that risk is notably elevated still, and we have a short-term macro view that says recession is still potentially very much in the cards over the next few months, and that ultimately would be very bad for things like equities. So my overall message is this is a time for patience and prudence, and not to get cute. These are just conditions. I can tell you of several where the market just kind of bounces around within a range, and sometimes it can go a couple of years, like the 2014 to 2016 stretch, or longer if you look at it historically. Typically, though, when you break out of these periods of malaise, those are special times to be invested accordingly or properly. In fact, the longer the malaise, ultimately the bigger the breakout. Now, breakouts can go in either direction. So right now, we think there's some risk of a downside breakout. Ultimately, if indeed we get there, if indeed we get that last leg of the bear market that's consistent with declining earnings and recessionary conditions, before the recession is over, the stock market is going to bottom if history runs true to form, and there's no reason to think that that's not the case. And asset prices in general are going to bottom. And we want to be on our toes because we have themes that we think are going to be very important to exploit during the next bull market. And the next bull market will begin typically amid a great deal of panic and capitulation by the crowd. And clearly we don't have panic and capitulation right here. We have a market that is definitely trending lower, lower highs and lower lows since the end of July. And indeed, this could be the beginning of that next leg down that I'm talking about. But there's reasons to be skeptical, and I'll go into that essentially now, and then we'll get to the charts. So the reason to be skeptical that this is it is simply the nature of the trading. I think it's fairly clear that the market is feeling angst over higher yields, higher interest rates, over Jerome Powell's commentary yesterday that monetary policy is indeed not too tight given the data that have come in, given the inflationary numbers and so forth. Not too tight suggests that they could get tighter. They could raise rates even higher. Now, I have a lot of people say to me, somebody said it to me yesterday, that they hiked a couple times here, the last couple times, and mortgage rates went up, and implying that mortgage rates went up because the Fed hiked. Well, mortgage rates, I believe, have hit 8% on average now, 30-year fixed. And the Fed has been essentially signaling that they're probably done hiking, and I believe they should be done. But mortgage rates have gone up anyway, right? So what's that all about? Well, if the Fed is indeed done hiking and the economy is doing okay and inflation is actually starting to heat back up, well, then they're not going to push hard against it, in theory. That may be what the market's discounting. And therefore, inflation isn't going anywhere and yields should be higher, mortgage rates should be higher, and so forth. What the Fed is saying is that these market rates are going to do the heavy lifting for us, meaning 8% mortgage rates are very constrictive, right? Just as one example of a lending rate. And that's true. And therefore, we probably don't need to hike. We need to just wait this out and let this take care of slowing the economy and the labor market and so forth to the point where it starts to come back down. And they'd love to live in, I think, to some degree, when you look at the odds, this fantasy land of soft landing, right? And I think they'd love to be able to pull that off. And I think many on Wall Street really want to believe it so bad that they're convincing themselves of that narrative. And again, I'm open to it, and I can tell you, I can describe the pathway to getting there. I just think it's very low odds that we actually do this, pull this off, without something bigger hitting the economy and therefore bigger potentially hitting the asset markets. Hence the really important message here to be patient and to be prudent, to be diversified, and so on. So why would this higher yield in this environment not be the catalyst for the next leg down? Well, because the catalyst in our view for the next leg down actually is going to coincide with falling yields and a Federal Reserve that is threatening to and then ultimately cutting interest rates. Now, that's counterintuitive to most. It's certainly counterintuitive based on the character of the trading we've seen of late, because falling yields and easing monetary policy should be resoundingly bullish for stocks. And I actually think that will be the initial impulse, that when we see yields begin to come down and the Fed really start stepping in with some soft talk, well, that's going to be probably bullish for a moment for the stock market. That moment could be months, right? Weeks, months. Ultimately, though, if that continues to descend in terms of the conditions that inspire lower yields and a lower Fed funds, or lower monetary policy, or easier monetary policy, well, then that ultimately is the Achilles heel of the stock market, and that is earnings, right? In a falling economy, earnings get crunched, and stocks are not priced generally for that scenario, and they'd need to come down. So I could get into stubborn inflation and whether or not the Fed's going to be Johnny on the spot like they always have been, and then that remains to be seen. They implied that maybe they won't be, and that should have the market even more nervous. But we'll wait and see. So I think there's potentially quite a bit more to play out, is my message, and we may have to be patient for a bit longer. So time will tell. But in terms of here, what we're doing, PWA, is continuing day in and day out to go through our processes to continue to formulate our longer term theses, let them evolve, be objective, open-minded, test where we could be wrong, listen to the folks who we pay for their input. We've assembled, in terms of where we spend our resources, what we would call a really good array of the world's best strategists and economists that at our disposal, and we get first-hand view of what they're thinking, why, compare that to our own theses and so forth. And that's how you do this. And you do it with a patient long-term perspective. And again, when the short-term risk is what we think it is, then you hedge your risk. You can't hedge all of it. We will have drawdowns. It's inevitable if you're in a position to make money in this market. And but you can mitigate that through proper planning and hedging and so forth. Okay, so those of you who do not enjoy the chart analyses, thank you so much for hanging with me that long, and look for the economic update here shortly. As for the rest of us, well, there is your daily S&P 500 chart. And remember the last time I drew this bear flag pattern that looked not unlike one that occurred right before the last hurrah and the now bear market low of 3,500, which happened over a year ago. This is just a 1-year chart. So right now that's playing right on the line, right? And that would take us down around this 4,100 mark that, as you can see, my bold yellow line here, I've got marked out as pretty stiff potential resistance. We'll see if that plays out. Ironically, it just coincides perfectly with where the extension of this bear flag would ultimately take us. Clearly, 4,200 is looking like support. There's really not much supporting it, at least on the chart, if anything, between where we are now, which is about 4265. This is a delayed chart, and that 4,200 mark. But it would not surprise me to see some buying, and of course it's going to hit that 200-day moving average before then, which very easily could support at a minimum a bounce over the course of at least a few days, I would think. One thing that's really beginning to look troubling and would suggest that maybe we're about to embark on that next leg down would be the longer term charts. Here's the weekly 3-year weekly chart. Each bar is a week. So there's your downtrend line, right? What really has my attention is the momentum. So on the longer term charts, these buy and sell signals, they're slow to develop, and when they do and they gain momentum, that's something to be concerned about. So there's that 4,300 on the weekly. You can see that big kind of that engulfing candle right now. It captures the full body of the previous week. Not a really good look, I have to be honest with you right here. So that suggests that we could be embarking on something more meaningful to the downside. And then on the monthly chart, which is really the deep monthly and weekly too, but more the monthly analysis that had us targeting 3,500 as the bear market bottom, which is exactly where it hit. Remember, we were having that conversation up here, and we said that'll be it if we don't have recessionary conditions looming. But the thing is, we did. So I said, well, then probably not the ultimate bottom. This has been a long, if we're right, bear market rally, longer than most historically. The fact that we're now breaking below that uptrend line during this rally, not a good sign. If we roll back into a sell signal on the monthly MACD, well, that would not be a good sign. You can see we did that right before that 35-ish% decline around COVID. Both the Fed and the federal government said, ain't gonna happen. So trillions upon trillions of dollars came to bear. And when, looking back, you'd say, well, of course, that's the recession. It wasn't allowed to happen. The question is, how do we digest those trillions and trillions? Well, certainly they goose the stock market in a big way, right? But we got to digest that. And what happens on the other side of that? Right now, this is a concerning look. Okay, so jumping over to the NASDAQ, I have the daily chart up because I'm looking for the prospects for a bounce here, right? And we may be getting it when we look at yields. I'll talk about yields. I think that's a very important conversation here. But it's not really a very compelling. Here's the daily, 60-minute, 60-day chart. And, you do have, absolutely, I think you have a falling wedge, and that's a bullish pattern. But typically we want these against, bullish divergences, right? And we're just not getting those. The only thing that I think a short-term bull has to hang his or her hat on would be that we're just now moving into oversold territory on the hourly, right? You can see we got here and we did nothing but consolidate a little bit before we ultimately came down and came down lower here, late September. Here we were oversold, and you can see it was a prelude to a really nice bounce and then a buy signal on the MACD. So this is very much in the cards on a short-term basis, particularly if we start getting weak data and softer inflation data, as I explained in my opening narrative. We'll just go to the daily on the NASDAQ 100. You can see, as I've warned here, I said you really don't want to roll over here on the MACD, and we are, and so that's what the bulls don't want to see. But just in terms of the chart, you can see here we've tested that 370 on the Qs, which is the ETF that tracks the NASDAQ 100. Falling below 360, I've got that line there because not really anything to help it down to 350. It's trading at 359.02 as I speak right now. And then below that, we just have kind of a gap. Remember my volume analysis, there just wasn't any right in here. And then it's like, you break that with some momentum, and 320 is going to come probably pretty quickly. At least that's what the technicals to us suggest right here. Looking at all-important yields, man, they have been stubborn. I get it. I just listened to a gentleman who's considered one of the best bond analysts out there. And he's basically implying there's more upside between now and the end of the year. And a lot of people are focused, I think rightly so, on all the Treasury issuance that's hitting the market and the lack of interest in that issuance. Now, yesterday morning, I did show that the 20-year auction actually went off very well compared to the disaster that was last week. From a pure technical perspective, though, folks, we do have what looks like a setup for yields to come down. Now, they're coming down a little bit today, and stocks aren't rallying on that, but ultimately, if we do get yields to come off the boil, and that would be on weak data and so forth, that's what the stock market needs to see right now to get at least a snapback rally off of the recent decline. And remember, the first part of October was really good, and that's something we flagged in our equity market conditions update. But it's since rolled over, and the technicals have gotten more ugly since then as well. So I'm not sure whether I can say it's consensus or not, but it seems like most of the commentary that I'm running into is very bullish yields right now in the short run. That's bearish stocks. The technicals say right here that maybe they're getting too far on that side of the boat, and we could actually see a snapback decline in or snap down in yields, a snap up in bond prices. I would think right now that would be bullish for stocks. Just depends. It all depends on other perhaps geopolitical and macro information out there. But purely on how the trading has been going of late, that would be bullish for stocks in the short run. Okay, take a look at gold. Gold has been very interesting. The last chart I'm going to show you a comparison to gold and bonds and then the dollar. Man, what a rally right here. And that's a little bit counterintuitive based on how gold has been trading. The headline narrative is that this is a defensive play against what's going on in the Middle East and so on. So perhaps that's the case. It's that, or it's gold actually sniffing out that this may be peak yields and that things may be about to turn, and the nominal rate relative to inflation is about to come down in a hurry. Could be that as well. I kind of hinted that may make some sense to me, I think, in our last video. But it is kind of defying the trend in trading this year up to the last week or so. And what I mean by that is essentially this chart. So here is the 10-year yield in blue. Here is gold in white. Notice that it's been pretty negatively correlated for the last year, meaning when gold is up, yields are down, or when yields are down, gold is up, whatever you want to say if one is the catalyst for the other. Correlation is not always causation, but in this case, you might say that it is, at least, and it would be yields that inspire the move in gold, right? Well, note here lately, yields since October 11th, so the last 9 calendar days, yields have spiked up, and gold has spiked up with it. Okay, so either gold is spiking up on world fears, right, or gold is anticipating a scenario that helps the gold relationship to real yields, right? The other thing worth noting is the moves in the dollar. So the dollar is something that a lot of the time is going to trade on interest rate differentials, the U.S. interest rate or interest rate trends relative to what's going on in Europe and other parts of the world, right? Because the dollar is up or down relative to how it trades against other currencies. So you can see that it's been trading largely based on the move in yields, right? You can see that there's real correlation there for the most part. Now, yields have spiked up, and the dollar has, to some extent, right, rolled over right here. Now, in our equity market conditions index, the dollar is a very important component of that. Remember, we were bullish the dollar in August, and we said that's bearish for stocks, and that's what happened. Then the dollar looked like it was getting a bit overbought. So we went neutral, not bearish the dollar, but neutral, said it still could be problematic. And it just continued to shoot up. And September was a real ugly month. In fact, August and September were ugly months for stocks. Definite right now anyway, near term negative correlation between stocks and the dollar. Now, notice though that yields, of course, went up, and that makes sense, okay? But here yields are continuing to rise, and here you got the dollar rolling over a bit, and you've got bonds rallying. So I don't have any conclusions, obviously. This is very short term, right? It's just 11 days. Long story short, we had that here, and then finally bonds gave way. If bonds give way here, you would think it would be good for stocks, but if they give way to massive geopolitical angst and people rushing to the Treasury for safety and weaker economic data, well then the beginning of the next leg down, if one is coming, has already begun, and gold and perhaps the dollar to some extent, because if the economy comes down, you don't get that interest rate differential. It's supportive of the dollar. But if it comes down in a big way, right, and people rush into treasuries and force the yield down, well, then you're going to have the dollar going up. And that ultimately just kind of seals the deal on how weak the stock market would be, because a rising dollar has been and will be for the time being a weight on equities. So folks, I know I said a lot there. Hope it was meaningful and interesting to you. Appreciate you hanging in there and watching and listening. And I'll be back soon with your economic update. Have a great rest of the day. Bye-bye.